Hello, good evening, and a warm welcome to everybody. We are very sorry there was a technical glitch which caused the delay. So, my warm welcome to all our valued customers joining us from across the globe and other parts of India. On behalf of Kotak Mahindra Bank, it is wonderful to have all of you with us today on our Kotak Live platform for this webinar on a topic that continues to be of great interest to investors: unlock India's potential for investments in equities and overall market outlook. Hello again, I'm Rashmi Kedia. I will be your moderator for today's session. We truly appreciate you for taking the time to join us today. So for all our NRI customers, India often represents more than just an emotional connection. It is also an economy that many of you follow closely and see as an important part of your overall investment journey. You all will agree India's economic landscape has been evolving rapidly, supported by strong structural trends, changing customer aspirations, growing participation in financial markets, and an increasing focus on infrastructure and innovation. At the same time, markets are dynamic, and making sense of opportunities requires the right perspective and a disciplined approach. And that is precisely what we hope to explore today. On this webinar today, we will cover three key topics today. One is current Indian market outlook. Second, impact of global economy on Indian markets. And last but not the least, way forward in the current market condition. So it is my privilege to introduce our esteemed guest speaker, Ms. Shibani Kurian, Senior EVP, Fund Manager and Head Equity Research. Shibani carries over 2 decades of experience in equity fund management and heads the equity research team. Prior to joining Kotak AMC, she has worked with UTI AMC and Donne Day AV Advisors Private Limited. Thank you, Shivani, for taking the time to join us today and share your perspectives and insights on current environment, the factors shaping the markets, key themes, opportunities that investors may watch out for, and the broader outlook going forward. So without taking any more of your time, it gives me immense pleasure to invite you to take us through your session. We will also have a question and answer session towards the end. So we encourage all our customers to share their questions in the chat box. So without further delay, let's get started. Over to you, Shivani.
Thank you so much for the warm introduction, Rashmi, and hello to all the participants. It's a pleasure to be here today to discuss what's happening both at a global economy perspective as well as Indian markets and the way forward. So we are experiencing what we call as volatility, which is the name of the game as far as equity markets are concerned. But how to navigate that volatility is something that I will spend a lot of time to discuss. And of course, what are some of the structural drivers for our markets going forward? So without much ado, let me just share my presentation and we'll just kick this off. So just give me a second.
Yeah, sure, Shivani.
Yeah, I hope this is visible, Rashmi.
Yeah. Yes, it is visible.
Okay, great. Okay, so as Rashmi pointed out, that no discussion on the markets is complete without understanding the global macro backdrop in which we are currently functioning. Both at a global level as well as at an Indian level, the economy does have a significant bearing on the market. And as you would know today, that what is happening from a geopolitical perspective, oil prices, inflation, interest rates, all of this has a bearing on our markets. So first of all, let's talk about and see what's happening at a global economy level. Now, clearly, what we are seeing is that the period of ultra low interest rates is now behind us. Across the world, central banks are either talking about hiking policy rates or have already started hiking policy rates. So therefore, what we are really seeing and what we are operating in is a world where essentially short-term or very low interest rates at the shorter end of the curve is now behind us. In fact, if you look at the steps that have been taken by central banks over the last, say, 6-month period, what we are really seeing is that global interest rate hikes are outpacing cuts. And this is true for both the developed market as well as emerging market central banks. So essentially, what you can see from the chart is that the period that we went through post-COVID, where central banks around the world were cutting interest rates, now central banks around the world, both developed market as well as emerging market, have started to hike interest rates. And therefore, as I said, the era of low interest rates, at least for the time being, seems to be behind us. Now, at the same time, while the interest rate trajectory is changing, global growth expectations have actually risen. So this is actually a survey that is done by Bank of America for global fund managers. And global fund managers at a net level are now expecting a stronger economy at a overall level. And in fact, even if you look at US markets, the expectation is that the global growth should improve from here. And this is some sort of a dichotomy, because on one hand, you have higher inflation and also the expectation of higher interest rates. And more importantly, and very surprisingly, despite that, all that you've seen in terms of trade and tariff, global trade in this new world order is actually thriving. So if you look at the chart, what it really tells you is that as a percentage of GDP, from the COVID lows, the global trade has actually gone up considerably. And even now, with all this noise around tariff, global trade is still thriving. And that seems to be the world order, despite all the risks that we have seen. Now, as you know, the key point of discussion in every macro presentation is what is happening on oil prices. Oil prices have been yo-yoing all over the place. In fact, there was a period of time when it was believed that the war in the Middle East was coming to an end, and therefore oil prices came off. And now oil prices have risen once again, closer to $90 a barrel for Brent. However, when you look at the crude futures are actually indicating a reversion to mean. So while your current spot prices are still high, closer to 90, the futures are kind of indicating that there will be a mean reversion and crude prices should come off over a period of time. Now, of course, time will tell how soon this happens, but this is an indicator that we keep watching closely in terms of what the market is really expecting from a crude price perspective. Now, with all that is happening across the globe, Asia is clearly pivoting to energy security as being the key driver for policy. So whether it be focusing in terms of renewables, battery storage, or becoming more self-sufficient as far as power is concerned, across the board and even in India, there is a clear pivot and a policy pivot, if I might say, towards renewables and power, and essentially bringing about energy security. The war in the Middle East has clearly shaken up the world, and therefore all economies around the world are focusing in terms of energy security, and that is the key thrust area as far as policy is concerned. Now, with this backdrop, there are some nuances of the US economy that are also important to pay attention to. Now, while the global growth expectation and more so the fund manager expectation on global growth has been on an improving trajectory, if you look at the US GDP growth on a YOY basis in Q2 of 2026 calendar year, growth has actually slowed down a bit. Now, more importantly, when you look at what has been happening on the tariff front, now the essential premise on which tariffs were imposed was that there would be higher collections, and therefore, because of the higher collections, the country would be able to address its twin deficits, both current account as well as fiscal deficits. However, what we have actually seen is that the tariff refunds have wiped out all revenue in May and June. So at a net level, there has been actually no impact of this higher tariffs that were imposed over the last 1 year period. So it seems to be an exercise in futility at this point in time. And the tariff refunds have pretty much wiped out the tariff revenue in the months of May and June. Now, most importantly, and this is again a a lot of debate that's going on is what is happening as far as the hyperscaler capex is concerned. And again, our belief is that while today the world may be ignoring some of these facts, this is something that is going to be a key driver going forward in terms of how the global macro really shapes up. So if you look at this chart, what it really tells you is that capex is jumping significantly in 2026, closer to about $769 billion, which is an 87% rise. And from there on as well, capex is expected to rise even further going into 2027. So therefore, all these hyperscalers, in terms of their spend on AI related capex, the numbers seem to be rising even this year as well as next year. Now, what is happening is that this is unprecedented in nature. Now, typically, when you look at these hyperscalers, and this is data for the four major hyperscalers, CapEx was so far being funded by operating cash flow because these were typically high cash generating companies. But now, when you look at CapEx to operating cash flow, and that's the red line in your chart, you will see that that number is now closer to 100%. That means all of the cash that these companies are generating is going into funding CapEx. And also, CapEx as a percentage of revenue has gone up quite significantly. And therefore, as AI CapEx keeps increasing, the ability of these hyperscalers to fund this CapEx out of their own internal accruals goes down. And that has ramifications on the debt market. Now, AI capex has accounted for nearly 80% of incremental US GDP growth. And therefore, the growth that you saw in the earlier few charts, a lot of that growth today is being driven by investment, and that is essentially AI led investment or capex that most of these hyperscalers are taking up. Now, as I said that earlier, a lot of the investment and capex was being driven by free cash flow and internal accruals. But now, as more and more of that cash is being used to fund capex, hyperscaler free cash flows are now expected to turn negative in 2027. And this is a significant deviation from the trends that we have seen over the last decade or so. So, this is for the first time that we are seeing this sort of an event where free cash flow turns negative and hyperscalers incrementally will have to borrow more to fund the capex. And this is a trend that we are really seeing. So if you look at the data between 2025 and 2026, the four major or five major hyperscalers have seen a significant rise in terms of bond issuances because, as I mentioned, now internal accruals are not adequate to fund this capex, and therefore bond issuances have started to move up. And again, this has a ramification from a debt market perspective as more and more of bond supply hits the market. And more importantly, when you look at the cost of insuring against default by all these bonds that are being issued by the AI hyperscalers, the credit default swap spreads or the CDS spreads for all these hyperscalers have seen a sharp rise, which means that the bond market somewhere is worried. And therefore, the cost of insuring against default by these AI hyperscalers are rising. And this is a phenomena that is continuing even today. So what this really means is that as more and more capex is undertaken, the risk in terms of whether the companies are able to generate enough returns to pay back the loans that they are taking and also to generate an ROI on their investment, that risk keeps ballooning. And again, it has an implication because, as I mentioned, more than half of the incremental growth in the US that you're seeing today is coming because of this incremental capex that is being undertaken by the hyperscalers. So, what this really tells you is that everyone is paying in and everyone is waiting for a payout. So, today you are investing, but there is no sign of the payout or the ROI on your investment. So, it's still wait and watch. And this can prove to be either a great sort of a situation where because of the capex undertaken today, you see huge ROI, or it can be a bust. We don't know where we are today, but as more and more of the capex gets funded by borrowing or by debt, that makes us uncomfortable at the margin. Now, long-term interest rates in the US have moved up. Inflation expectations have remained stable, but they've not come off. And therefore, with inflation expectations remaining stable, what we are really seeing is that the bond yields in the US have moved up. There have been some attempts to bring down the bond yield by increasing the bond buyback program and infusing liquidity into the market. But as you can see, and the data shows you even today, that bond yields still continue to move up despite the expanded buyback programs. US debt has remained elevated. So national debt in the US at $39 trillion is something that is huge. And this debt is something that one needs to again be cognizant of, because servicing the debt clearly is a big burden from a US economy perspective. And most importantly, when you look at the US stock market, it has become lopsided. So if you look at the data, the black line is the percentage of S&P 500 market cap of the 250 smallest firms. And the blue line is the percentage of S&P 500 market cap of the 10 largest firms. Now, the top 10 firms today are 43% of S&P's market cap, which means that the divergence between the top 10 and the smallest 250 have just widened. And therefore, the market has become extremely lopsided. And that again brings the risks of polarization as far as the US market is concerned. Valuations have also risen because of the outperformance of the US stocks and the US market as a whole. And therefore, today, when you look at valuations on a price to earnings basis, valuations are far above their long-term averages and their mean levels. But however, the US consumer continues to benefit because markets have moved up. There is considerable amount of wealth effect. And therefore, the belief is that US consumption continues to benefit from the wealth effect tailwinds that we have seen, until and unless, of course, there is a reversal as far as the markets are concerned. Now, with this backdrop, where you've seen the global economy going through volatility, US markets, while on the way up, have also been supported by a significant amount of increase in investments and capex, specifically AI-led capex, leading to further uncertainty. The question for the Indian economy is that, are we in for a rough ride? And are things improving at the margin as far as the Indian economy is concerned? Now, when you look at India vis-a-vis some of the emerging markets, India actually tops emerging market trackers across various macroeconomic parameters. So whether it be real GDP growth, export growth, the inflation, as well as PMI manufacturing, Indian markets have done fairly well and macro has been largely stable. Where we have kind of lost out is, of course, the way the stock market has moved, and of course, the risks on the trade deficit front or the current account deficit because of oil prices moving up. And I'll address each of this as we go along. Now, for India, as you know, that monsoons play an important role. The monsoons this year have seen below average trends. And today, as we speak, the cumulative monsoon is about 13% below normal. Now, while there has been significant progress that has been made as far as agriculture is concerned, and employment has become more broad-based in rural areas and not only dependent on agriculture, the monsoons still do play a role. Typically, what we have seen is that when the rainfall deficit is more than 10%, agri output has been impacted, and those are those red bars that you can see on your screen. However, the data today shows that the sowing as of now is only about 2% lower than what it was last year. So while the rainfall deficit has been more than 10%, the sowing deficit has not been significant. There is no major growth, but the sowing has been more or less in line with the last year's average as far as the kharif or the summer crop is concerned. But we will wait and see how trends progress for August and September, which is when the monsoons really end. But for India, what is most important is that the manufacturing policy has shifted decisively. So whether you look at the electronic manufacturing segment, where there has been a significant increase as far as domestic production is concerned, the indigenization of defense procurement, as well as exports, core sectors which have been gaining as far as global manufacturing is concerned, and of course, the entire success story as far as the smartphone exports or the mobile exports are concerned, which has seen unprecedented success. So clearly, the policies that have been brought into the arena of manufacturing has started to yield results, specifically so as far as mobile phone manufacturing, electronic manufacturing, which is EMS, as well as defense is concerned. And even in some of the core sectors, there has been a shift as far as the share is concerned in the global manufacturing scenario, which is what you can see in the chart on the left-hand bottom corner. So across the board, I think this has been one major change as far as India's growth construct goes. India's defense exports are on the rise, and as you can see from the chart, there has been a sharp jump in exports over the last year or couple of years. And this is again ties up with the fact that there is considerable amount of focus not only on indigenization of defense, but also to make defense competitive in the global arena as far as Indian manufacturing is concerned. Importantly, if you look at the recent data supported by the policy changes, which include the GST rate cuts, auto retail sales have been robust. So if you look at the data that is coming out in the period of July, then August to June 2026, there has been an increase. And this is across the board. So whether it be two-wheelers, passenger vehicles, the MHCV segment, which is the heavy commercial vehicle segment, and the medium and heavy commercial vehicle segment, as well as tractors across the board, I think aided partly by the GST cuts that have been undertaken by the government, you have seen an improvement as far as retail sales are concerned. But I think the most important factor and the data point that points towards improving macro health has been the fact that credit growth of the banking system has moved up, and now it is running at close to about 18%, which is a decadal high. Deposit growth has also improved, and because of the FCNR flows that have been stronger than what was expected, another 2 to 3 percentage point can be added to the deposit growth to support the kind of credit growth improvement that we have seen. And credit growth has seen improvement across the board, but consumption has typically been the highest segment where credit has gone up. So if you look at the share of loans by credit taken and the breakup of the same, what you can see in March 2026, the consumption segment or the consumption loans or the discretionary segment has seen a sharp jump in terms of the share of total credit, followed by gold. And of course, this is because partly because of demand and partly because prices have moved up, then auto, mortgage, as well as business loans. So I think it's been a pretty broad-based improvement in credit over the last decade, but clearly retail and consumption-led loans have been the major drivers if you look at the trends over the last decade as far as credit is concerned. Public capex has slowed down, and part of it is because obviously fiscal deficit cannot keep funding capex, and hence at the beginning of FY 21, 22, and 23, we saw a sharp jump as far as capex is concerned, both central government as well as state government capex. But now that trend is kind of plateauing out, and as you can see, the growth rates have started to normalize. And hence, as public capex slows down, the onus of driving investment growth in India is clearly on the private side. Now, contrary to belief that private sector capex is not taking place, what we really see is that corporate capex, especially the listed corporate capex, has seen an increase over the last couple of years. And if you look at the data on 2026, almost 13 trillion rupees of capex has been undertaken as far as the corporate sector is concerned. So there are clear signs of improvement as far as private sector capex is concerned. However, on the other hand, one must look at a more normalized run rate as far as public capex, both center and state go, primarily because of constraints on the fiscal side, which, as you know, means that one, the government focuses on fiscal consolidation, but also has to manage the capex side of the equation. Now, for us, the Achilles heel in the macro environment is clearly what is happening on the balance of payment side. Now, on the balance of payment side, there are two key factors. Services exports for us have been strong, and that is primarily because of the evolution of the GCCs. And as the GCCs in India have continued to rise, that has supported India's services exports, even while IT services export growth has seen more muted trends. So, overall, if you look at the services exports, there's been a change in composition with GCCs actually leading the way, while IT services growth has been more muted than its long-term average. The problem is on the trade deficit side. And here, as oil prices have moved up, the trade deficit has worsened, which means that with oil at closer to, say, if average $80 to $85 a barrel for the year as a whole, we will possibly end up with a current account deficit, which is at about 1.5% of GDP. And therefore, it is important to have capital flows to fund this current account deficit, which is what the government on the RBI have done in order to ensure that at a overall balance of payments perspective, we are okay. Now, as you know that the INR has sharply depreciated against the US dollar, but RBI today, as I mentioned, is holding about $100 billion of short for US dollar forward, and that has been essentially done to defend the fall of the rupee. So RBI has been intervening in the currency market to defend the rupee fall. Now, in order to ensure that, as I said, that there is a trade deficit and the current account deficit. Now, in order to ensure that an overall level, the balance of payment does not turn into deficit, what has been done is to ensure that there are FCNR flows, ECB flows that come into the economy as per the new scheme announced by RBI. So far, the collections have been actually even better than what was anticipated, which is why the RBI is closing the scheme at the end of this month. And we've seen more than $60 billion of FCNRB flows already, which means that at an aggregate level, getting to about $100 billion of flows is something that is clearly possible. And that will more than offset your current account deficit, which means that again, at a headline balance of payments perspective, we will be positive at the end of the year, which will take off some pressure as far as the Indian currency is concerned. So our belief is that the pace of currency depreciation should moderate from here on. And in fact, we are building in far more stable currency trends as compared to the sharp depreciation of the currency that you saw in the last 6 months to a year perspective. Now, with this macro backdrop, both global as well as Indian, let me now focus on what is happening on the equity markets. Now, India has underperformed. So if you look at dollar returns on a 1 year basis, and this is data as per the end of the last month, India has underperformed. There has been some rebound in the month of August, but clearly the underperformance of India vis-a-vis the rest of the world and emerging markets has been stark. Now let's also look at why we have underperformed and what it means for us and where do we go from here. Now, since the bottom that we saw in the month of March, which is when the war broke out in the Middle East, markets have rebounded, but there has been again a divergence in terms of how markets have moved up. The large caps have remained largely flat or slightly up, but the small and mid caps have clearly bounced back faster than the large caps. So the small and mid cap is the red and the blue line, and these have seen sharp rebound since the lows of March 2026. So clearly this has been a market which has been driven by the broader segment rather than the large caps participating in the up move. Also, during this period from February 24th, when the war started out in the Middle East, the sectoral performance has been significantly divergent. So on one hand, small and mid caps have done better than large caps. Sectorally also, we've seen sharp divergence of performance. So for example, sectors such as pharma, defense, capital markets, real estate have done really well, while sectors such as banking, IT, and to some extent even oil and gas and FMCG have underperformed the markets. So clearly this is a market where stock picking as well as being in the right sectors has been crucial, because the divergence across both stocks as well as sectors has been huge. And therefore, as a fund manager, your job has just become even more difficult to be in the right segment and to continuously outperform the market. Now, because of the kind of underperformance that we have seen some moderation as far as valuations go. And so market cap to GDP ratio has actually come off in 2026 FY. But our expectation is that that should improve going forward in FY27. FIIs have been huge sellers as far as Indian markets are concerned. However, they turned net buyers in July. And the data as far as August is concerned, month to date shows that FIIs are still net buyers in the month of August. So July and August have been positive, while if you look at calendar year to date, FIIs have been net sellers to the tune of almost $24 billion as far as Indian equities are concerned. Now, remember, I showed you that chart which showed that there was a huge divergence at a sector level. Now, the sector that has seen the brunt of FII selling has been the banking sector. So, calendar year to date, FIIs have sold almost $12 billion as far as the BFSI stocks are concerned. And taken together with IT, the selling has been to the tune of almost $15.5 billion. So, it's been huge. In fact, if you look at last calendar year, the technology space was the sector where FIIs saw most selling, which was about $8.5 billion. Now, as compared to the full of last year, calendar year to date, which is still the month of till the end of July, the data shows that the selling has almost been double. So, therefore, banks and IT have seen the highest selling pressure as far as FIIs are concerned, and that is reflected as far as the sectoral performance of the sectors go, as we saw in the previous slide. Now, given the fact that FIIs have been such huge sellers over the last 2 years, the decadal FII flows are now almost zero over the period of August 2016 to July 2026. Now, during the same period, DIIs clearly have been the saviors as far as the market is concerned. And the DII flows have been so strong that it has helped the markets navigate the volatility that otherwise would have been the name of the game, given the kind of FII selling that we have seen. And post all this selling, FII holding of Indian equities is now at a 2 decade low. So therefore, what we are seeing is that FII holding at the end of the quarter, which is the right-hand side, is now below 15% as far as Indian equities is concerned. And at its peak, it was closer to 20%. So therefore, FIIs have been huge sellers of Indian equities and their holdings have come down very sharply, close to a 2 decade low. And more importantly, positioning by foreign funds as far as India is concerned relative to India's weight, both in the emerging market index as well as the global MSCI benchmark. Most of the funds, which are global funds or emerging market funds, are underweight India. So not only have FIIs been selling, their position as far as India is concerned is also extremely light and they are underweight on India. Now, this is an interesting chart, and what the data point really shows is that while we've been seeing such sharp outflows as far as secondary markets are concerned, and as I mentioned, FIIs even calendar year to date are net sellers in the secondary market by about more than $20 billion. What you will notice is that in the primary markets, FIIs have been net buyers. So primary markets have seen FII inflows, and primary markets means your IPO market or your QIP market or your the blocks that have been happening. FIIs have been participating there, but they have been selling in the secondary market. So what this means is that it's not that FIIs are negative on India. It is just that FIIs have been participating in a different segment of Indian equities, and the secondary market has been bearing the brunt of such high supply as far as paper is concerned. So it's not that FIIs don't want to be in India. In fact, most of the IPOs, you will see the anchor investments have a sharp or have a pretty large representation of FIIs. But it's just that because they are participating in the primary market, the secondary market has seen outflows. Now, most importantly, domestic institutional investors continue to remain net buyers. And again, as you know, the SIP flows have remained sticky over the last many months, which is also providing the adequate support that is needed from a DII perspective. Now, while flows have been divergent across domestic institutional investors and FIIs, what is important to note is that earnings growth is now seeing some degree of stability. After 2 years, which is FY25 and FY26, where earnings growth for Nifty 50 had moderated to single digits, the expectation is that earnings growth should improve in FY27 and FY28 to mid-teens. And that is possibly something to cheer about because typically markets move as far as earnings are concerned. So if this earnings trajectory does improve and Q1 has been a good start, where if you look at Nifty 50 earnings growth, Nifty 50 earnings growth has been mid-teens, much higher than what was earlier expected, then the earnings trajectory should also provide a fillip as far as markets are concerned. Similarly, when you look at MSCI India, the earnings growth is expected to improve to 14% in FY27 and to 17% in FY28. Now that brings us to this entire debate about valuations. And so while earnings growth is improving, where are valuations? Now, as I mentioned to you, for large caps, the expectation of earnings is mid-teens. For mid caps, the expectation of earnings should be closer to 20 to 25%, and small caps of a lower base will see better earnings trajectory. However, large caps today on a 1 year forward price to earnings basis is trading at a 12% discount to their average. Mid caps are trading at a 13% premium, but with very strong earnings trajectory. And small caps are trading at more than 24-25% premium to their long term average multiples. So valuations are elevated as far as small caps are concerned. Large caps are seeing valuations which are below long term average, and mid caps are slightly above long term average, but here earnings growth has been strong. Now, if you look at vis-a-vis the MSCI EM, the Nifty 50 premium has also moved below its 10-year average. So India's valuations are now looking relatively better and below long-term averages when you compare it to the MSCI emerging market basket. And the premium at which India trades at is much below its long-term average as well. The point to note, however, is that equity supply in India has been consistently very high. Last 2 years has seen more than $50 billion of equity supply. This year also the trends show that equity supply is likely to remain high, and that can have a bearing as far as the secondary markets are concerned. And again, it's a data point that we need to watch out for. So what are we really saying? That at this point in time, with Nifty at about 24,000, be ready for volatility. There are factors that can impact markets because the geopolitical risks are still pretty much live. We don't have a solution to what's happening in the Middle East. Oil prices have been volatile, and there are supply chain disruptions. On the other hand, earnings growth has started to improve. And as I said, Q1 has been a great start to the earnings season. And expectation is of improvement of earnings growth in FY27 and FY28. FPI flows have started to turn the corner. So last 2 months have seen positive numbers as far as FPI flows are concerned. However, the equity issuance pipeline remains fairly strong, and that can have a bearing as far as the secondary markets are concerned. So near term, we will have to navigate volatility. But over the medium term, I think, and our view is that markets will follow earnings growth. If earnings trajectory, as is expected, moves closer to the mid-teens, then markets will actually track the long-term earnings trajectory. And of course, valuations in pockets are still reasonable. And here, as I mentioned, large caps and mid caps look better placed on valuations and earnings as compared to small caps, where one has to be a little bit more careful in terms of the kind of stocks that one picks. Near term, of course, we will have to contend with flows, news, and events, all of which lend to volatility as far as markets are concerned. I will quickly maybe just touch a brief in terms of our view as far as gold and silver is concerned. And this is often a topic of discussion as well in the overall asset allocation basket. Now, gold and silver both had a great run last year. From there, from the all-time highs, we have seen gold prices correct from their peak. It is linked to what's happening at a global level as far as interest rates, inflation, as well as geopolitical risks are concerned. And of course, when you see a sharp movement as far as one asset class goes, at some point in time, you do see some degree of correction. However, it is expected that the central banks will continue to increase their gold reserve. Again, this was a survey that was done by the World Gold Council in terms of what the expectation is of change over the next 12 months, where central banks typically said that they would either increase or gold reserves would remain unchanged. So from a demand perspective, it is likely that central bank demand for gold, as far as the reserve composition is concerned, likely remains intact. Also, China's appetite for gold has been incredibly strong. So when you look at the data for 2026, 2026 data continues to show that China's gold imports have stayed elevated in the first half, even while prices have moved down. So again, a sharp driver for demand for gold continues to be the Chinese central bank. And therefore, the question is, could gold catch up as global liquidity rises? Our belief and our overall view on gold from a demand supply perspective and a longer term perspective remains positive. Silver, on the other hand, has been a little bit more volatile. And our belief is that demand supply is not as strong as far as gold is concerned when you look at silver. And therefore, silver one has to be a little bit more tactical. Now, to sum up all that I have, spoken about in the last, say, 40, 45 minutes, this chart actually says it all. So, from an asset class perspective, we are neutral to equity in your asset allocation bucket. What that means is that if markets do correct from here on, we should use that correction to increase exposure to equity. Within equity, we should be equal weight large cap or slightly overweight large cap and overweight on mid caps, but be slightly underweight as far as small caps are concerned. We continue to be overweight on gold, and silver is a tactical allocation depending upon price movement. Now, from a sectoral perspective and themes, there are a few key themes that we are positive on. The first is financial services and the entire banking and financial services sector, which spans banks, NBFCs, as well as asset management plays and capital market plays. This we believe is a structural driver of the economy. And as we mentioned that with credit growth improving and the FCNRB deposits coming in, this is one segment where valuations are clearly in your favor. The second segment, which we are positive on, is the healthcare space, which is essentially hospitals and domestic pharma business. Here, we believe that the runway for growth is strong. The third segment is the entire discretionary consumption and the e-commerce space. Government policy are clearly focused on driving consumption growth, and GST cuts and the income tax cuts over the last year are policies that have been focused on driving consumption. Here, I must add that there is one large change that is taking place next year, which is the pay commission that comes into force in 2027. The pay commission means that the salary levels at the central government, state, and PSU or public sector companies and their employees are likely to go up considerably. And therefore, consumption, especially discretionary consumption, will be a sector where we are positive on. And finally, the entire manufacturing piece. And as we discussed in our presentation, the focus of policy to drive manufacturing led growth and increase investment to GDP across various segments is something that is leading to this entire improvement that we are seeing as far as manufacturing is concerned. So with that, I will stop my presentation and I will be happy to take questions and look forward to interacting with you. Niharika, who will moderate the questions, please?
Yes. Please allow me a moment.
Yes, sure.
Thank you, Shivani, for sharing these interesting perspective. What is particularly important for investors is to look beyond short-term market investment and understand the larger trends that can shape opportunities over the long term. So the key message perhaps is to approach investing with clarity of objectives and appropriate diversification, while remaining mindful that markets can have period of volatility. Now let's move to the interactive part of the session with Q&A, Shivani. So we are already receiving some great questions from our audience. So let's try to address maximum possible.
Yeah, sure. Yeah, look forward.
Yeah, thank you. So one of the question is from our customer is Indian equity markets are range bound up with strong growth resistance. USD is going up against INR, and Indian government isn't tax friendly for NRI investment compared to NRI country of stay or US stock market. So in such scenario, why should NRIs invest in India through MFs in India? Would it be more sensible to invest in global markets directly or through global ETFs?
Yeah, sure. So, of course, having a part of your pie, if you are able to, in global markets and global ETFs, is definitely prudent from an asset allocation perspective. However, when you talk about India, and it is true that Indian markets have been range bound in the last, say, year and a half, and the reasons we discussed, in the presentation. However, as equity market investors, one needs to look forward. So, what's changing? One is that post the kind of underperformance or relative underperformance of India, valuations have become reasonable. So large caps, for example, are now trading below their long-term average multiples by 10 to 12%. Mid caps are slight premium, but growth has started to pick up as far as earnings is concerned. And therefore, valuations are reasonable. Most importantly, from a macro as well as corporate earnings perspective, we believe that we are in a cusp of improvement and change. As we saw that last 2 years was characterized by Nifty earnings being low single digit. Now the expectation of earnings for Indian corporates and Indian markets have improved, and for FY 27 and 28, it is likely to move closer to the mid-teens range. So, coupled with earnings improvement, a far more stable macro environment, as well as valuations being reasonable, Indian markets start looking interesting once again. Now, as I said to you that, if you have an asset allocation bucket, today equities and Indian equities may be neutral. However, because of global uncertainties, if there is volatility and you get an opportunity and Indian markets correct or consolidate for a period of time, then use that opportunity to increase allocation as far as equities are concerned and Indian equities. But remember, markets will typically track earnings growth. So we are not building in a huge multiple re-rating for markets like we saw in the period of, say, 2020 to 2024, where markets saw earnings improvement and multiples expand. But what we are really saying is that earnings moving to mid-teens trajectory, markets will typically track earnings from here on, which again gives you comfort that both macro and corporate earnings move in tandem. And of course, valuations are in your favor.
Yeah, thank you, Shivani. Next question is, what are the top 3 or 4 sectors that are likely to do well during which time periods?
Yeah.
It's a very
So
interesting question.
Yeah, so I think we always want to look at sectors because remember I showed in a slide that if you look at even the period between March to now, there has been a huge divergence as far as sectoral performance is concerned, and therefore getting the right sector or getting the sector call right is very, very integral in the entire process. So there are 3 key segments where we are positive on. One is the financial services space. Here, as I said, credit growth has moved up considerably with the FCNRB deposits coming in, the cost of funds pressure that most of the banks were facing will start to moderate and earnings growth should improve. And this is one segment of the market where valuations are actually quite attractive. The second area is the entire industrials manufacturing space. Here, there are different segments to look at, whether it be defense, cables and wires, some of the new age technology segments, including, say, ones which are related to semiconductors or the electronic manufacturing space. This is a segment where we believe that growth is here to stay. While valuations may be expensive in pockets, but it is also possible to find opportunities, and this is a structural theme for us. The third theme is the healthcare space, where we believe that hospitals and diagnostics is again a structural growth area. Now, remember, as a country sees increase in its per capita GDP, everybody wants better quality healthcare. And therefore, the organized healthcare players and hospitals benefit. And that is already showing through in numbers as far as occupancy levels, margins, and profitability go. And finally, if I may sneak in a fourth segment, as I said, that as next year sees a huge jump up in salaries of the central government employees and public sector employees because of the implementation of the pay commission, discretionary consumption is likely to stay on an uptrend. Near term, again, there will be pockets of volatility because remember, commodity prices have gone up, right, as a result of the war in the Middle East. And therefore, there will be parts of the consumption basket or discretionary consumption basket which will see margin pressure. But going into next year, this could see recovery. So segments of discretionary consumption, including autos, is also a space where we have been positive on.
Okay, thank you so much, Shivani. One question is, assuming the price of oil rate remains upwards of USD 90 per barrel until the end of financial year 26-27, what can we expect the USD INR exchange rate to be? It's a very interesting
That's
question.
looking, that's gazing into the crystal ball, and I wish I knew and could give you a definitive answer. But as I was discussing, if oil stays anywhere between, say, 85 to $90 a barrel, our expectation is that we will have a current account deficit in the range of 1.5 to 2% of GDP. However, what has changed in that equation, and if you had asked me this maybe a couple of months ago, I would have said that's a huge negative for our macro. However, today, with the kind of inflows that we have seen as part of the FCNR deposit scheme as well as ECB scheme, I think by the time we close the schemes in the month of August, we will be more than $100 billion, which will more than offset the current account deficit, which means that at a net level, balance of payments will actually be neutral to positive. So that means that the pressure on the currency to continuously depreciate the way we have seen in the last year, that pressure kind of moderates. However, does the currency appreciate from here? The answer is no, because we are still a current account deficit country. Typically, normal year would see 2 to 3% currency depreciation. This year, we have seen about 10-11% currency depreciation. I think from here on, we are building in more stability in currency, staying within a band, but we are not building in a huge appreciation of the currency.
Yeah, thank you so much. One very, very interesting question on artificial intelligence. So, the question is, I would like to understand your perspective on India's economic outlook. As AI reshapes the global economy and reduces reliance on traditional IT services, how do you see India's IT sector evolving, given its significant contribution to the country's growth?
Yeah, so this is the hot topic of debate, whether AI kills Indian IT services. I'm of the camp, and we at Kotak Mutual Fund, we are of the camp that no, AI does not kill IT services. It just reshapes the way IT services as a sector works. So AI is a huge transformational change that is taking place. So there is no denying, which means that the traditional IT services as we know it will see change. And therefore, companies will have to evolve their business models to become more agile and to focus more on AI-led solutions for their clients as compared to their traditional application development, maintenance work that they were doing. Now, in the middle, as the companies, both at an enterprise level and Indian IT services, adopt to this change or adapt to this change, there is going to be a period of volatility, which is what we are seeing today. So, what it means is that as enterprises adopt AI, they will typically want productivity benefit and lower cost. So, therefore, there is a deflation that is linked as far as AI implementation at an enterprise level is concerned, which is why today IT services players are seeing slowdown on growth, because while volume of work is going up, there is price deflation as far as traditional IT is concerned in terms of services. So we will go through this period of challenge. However, over the next maybe year or 18-month, 24-month period, as the pie which is linked to AI or AI solutions that most IT services are providing, then the growth rates will stabilize. Our belief is that in the near term, Indian IT services does see pain. However, from a macro perspective, the good part is globally companies are still offshoring. And if you look at the number of GCCs that are being set up in India, that is going up. So from a software services export perspective, while IT services have slowed down, exports related to GCCs have gone up, and that has more than made up for the slowdown that you've seen in IT services. So yes, AI is going to lead to disruption, change in the way Indian IT services players work and the kind of talent that they hire. But the very fact that global companies are still setting up capability centers in India, which means that the talent in India is something very valuable and will possibly see us in good stead.
Thank you so much, Shivani, for so deep insights on investment outlook. I'm sure everyone joining us today will go back with a better understanding of the evolving investment landscape and the opportunities that India's growth story could present. Thanking to all our customers also joining us from different parts of the world. I'm sure you found today's conversation insightful and relevant. We look forward to bringing you more and more such engaging sessions and expert perspective in the future. Thank you once again. Have a wonderful time ahead. Thank you very much, all.
Thank
Thank you,
you so much.
Shivani, once again.
Thank you, Rashmi, and thank you to all the people who have tuned in. Hope this was insightful, and if you have any further questions, we'll be happy to address them. Please do